when it comes to crazy dividends, in Canada, we have the Purpose Yield shares. And of course, south of the border, we have those insane Yieldmax ETFs. Which is the better fit for you, or are they both outside of your risk profile? Fasten your seatbelts, folks. This is going to be a good one. The biggest difference between the Yieldmax and the Purpose Yield ETFs is that Purpose employs covered calls to generate some of that extra income, and Yieldmax uses synthetic covered calls to take the money generation to the next level. A covered call is an option strategy where an investor, in this case Purpose, owns an underlying asset such as Tesla or maybe Apple. They then simultaneously sell a call option on their Tesla or Apple stock. By doing so, Purpose collects a premium from the sale of the call option. The call option gives the buyer the right to purchase the underlying asset at a predetermined price. That's, of course, the strike price, within, of course, a specified period. So it does come with an expiration date. In a covered call, since Purpose already owns the Tesla or Apple stock, they are covered if the option is exercised by the buyer. A synthetic covered call, on the other hand, replicates the risk and reward profile of a covered call strategy using a combination of options on the sort of underlying asset. Instead of actually owning Tesla or Apple, Yieldmax enters into a synthetic position by purchasing a long call option and selling a short put option with the same strike price and expiration date. This combination allows Yieldmax to benefit from potential income generation similar to a covered call, but without actually owning any of the underlying stock. Join the conversation. Let me know in the comments if you hold any Purpose or Yieldmax ETFs. Your participation is well appreciated. Don't forget to like and subscribe to stay up to date on future content, and I thank you for that. Click! In terms of the potential for income generation, a covered call strategy typically offers a higher income potential compared to a synthetic covered call. This is because in a covered call, the investor collects the premium from selling the call option while still receiving any, dividends or distributions from owning the underlying asset. In a synthetic covered call, the income generation is limited to the premiums received from the options. We'll see in a little bit if this is reflected in the returns of our stocks that we're going to look at today. In terms of overall risk level, a covered call strategy has a lower risk compared to a synthetic covered call. In a covered call, the investor owns the underlying asset, and that provides some downside protection as the asset value itself can mitigate some of the losses. However, in a synthetic covered call, the investor does not own that underlying asset, and the risk is primarily associated with the options themselves. This can result in higher risk, as the investor is exposed to potential losses from adverse price movements of the underlying asset, without, of course, the benefit of owning it. We are going to compare a few of these ETFs, both the Tesla and Apple versions for each company. We will also bring in the actual stock and see how it shakes out. This should be interesting. We will start with Apple. Both the Purpose and Yieldmax ETFs have the same ticker of APLY, though they are on different exchanges, the NEO exchange in Canada and the NYSE ARCA in the US. We will start with the actual Apple stock, so ticker AAPL, on the NASDAQ. We will only look at the 2023 data for all of these so that we are comparing apples to, apples. When we look at the returns for Apple, in 2023, their stock has exploded from $133.15 up to $186.68. That, my friends, is a return on investment of 40.20%. Now, if we add in their dividends, they have a yield, by the way, of 0.514%. That gives us a total return, not much higher, but 40.56%. Nonetheless, for half a year, that is fantastic. Apple has done amazing this year as the NASDAQ moved back into a technical bull market. So now we can turn the risk up a wee bit and see how much more we could have made if we went with, let's say, Purpose. With Purpose and their covered call strategy, they did well, but did they do Apple well? Well, if we look at 2023, that ETF rose from $20.12 to $27.19. So that's a return on investment of 35.14%. That's not too bad. A little bit lower than Apple, but can that yield? They have a yield of 7.19%. Can that make up the difference? Well, not exactly. Their total return comes in at 39.29%. Holy banana bread. Apple did better when it comes to a total return. That is very interesting. Okay, so let's crank that risk up full throttle and see what Yieldmax has done. When we look at Yieldmax in 2023, their share went from $20.20 to $22.24. That's a return of investment of 10.10%. Okay. What about their yield? Their yield is much higher. It's at 15.48%. Now, if you don't have this in an RRSP and you lose that withholding tax, you're only going to actually receive a yield of 13.16%. But nonetheless, the total return on this baddie is only 11.52%. Now, in all fairness, they have only had one dividend so far, as they're brand spanking new. If they had been around for the entire year and had maintained that dividend, their total return would be closer to, drumroll, no drumroll, 18.66%, even still a big loss. More risk for less rewards. I don't suspect it was meant to go that way. In fact, if you are solely interested in passive income, then maybe it all boils down to those yields, and then, well, Yieldmax easily wins in that department. So that was Apple. Let's look at Tesla, who has been tearing up the stock market in 2023. Tesla has a ticker of TSLA, and they are also listed on the NASDAQ. In 2023, their share price went atomic, and it went from $118.37 to $256.60. Oh my God, that's a return on investment of 116.78%. Now, their yield is 0% because they don't have a dividend, but that means their total return is the same, 116.78%. That is not too shabby. I know this is hard to beat, but let's still see what Purpose can do with that little bit of added risk. So Purpose in 2023, well, they did really well. They went from $14.85 to $28. That's a return on investment of 88.55%. That's really good. Now, their yield is also fantastic at 13.07%. That gives us a total return of 98.86%. These numbers are still beyond awesome, but Tesla did beat them. I know the yield is insane on the Yieldmax ETF, so let's see if they managed to, well, win the day. In 2023, Yieldmax went from $13.40 to $16.65. That's a return on investment of 24.25%. Their yield, though, their yield is huge. It's a 56.52%. Now that takes us up to a huge total return of 60.67%. Once again, we can clearly see when it comes to total returns, the actual companies won the day. Keep in mind, if they were not absolutely pumping, these numbers may have looked a little bit different. In fact, I would say this is just how it goes in strong bull conditions. The company came in first, followed by the covered call, and then the synthetic covered call came in, well, last. I touched on passive income, and in the case of Apple, Yieldmax returned $1.73 USD, and using extrapolated data, Purpose made 83.5 cents, and Apple made 47 cents. With Tesla, Yieldmax leads with $4.88 USD, Purpose has $1.53, and Tesla has, well, a goose egg. Clearly, if you want passive income, and that is your main focus, then the covered call and synthetic covered calls become more of an option for you. If you are a Canadian, just be sure to keep your synthetic covered calls in a registered account so that return of capital does not come into play. In your TFSA, you do lose 15% to withholding tax that you cannot recover. However, in your RRSP, you are fine and no withholding tax to be concerned with. Personally, I hold AAPL and YTSL, so I have some solid growth from my Apple stock and the blue chip safety that comes with it. I have my risk on those YTSL dividends, though I have been known to take a few chips off the table to snag a wee bit on that crazy growth. Ultimately, what you do with your portfolio needs to match your own risk profile. If you are a conservative investor, then maybe it does make more sense to stick with those total growth blue chip stocks. The riskier investor, well, you have some of the more fun options open to you. Whichever risk profile suits you, just be sure to sprinkle in a very generous amount of due diligence as you decide which stocks or ETFs belong in your portfolio. Keep the learning going. Watch my video on Restaurant Brands International, linked on the left, or test YouTube's recommendation skills by checking out the video on the right. Your choice will decide the winner, and I will see you in the next video.